when Philip mentioned my boss, we mentioned his boss, I assumed it probably was Larry Fink, but we have kept, as in all great entertainments, you keep the headline act to the very end. Like the Rolling Stones, you come on at the end when everything else has gone through. And Larry Fink definitely fits into that category, not only as the founder of BlackRock and one of the world's biggest investors, but also as a powerful figure in many other ways already wandering onto the stage. Larry, have a seat.
I was told to wander.
Well, can we begin by talking a bit about America? And we talked earlier about short-termism, which I know you feel very passionately about. And I wonder if you could say a bit about what you think about where Wall Street is too short-term, and then maybe say a little bit about Washington as well.
Well, thank you for having me. I don't think it's a New York or a Washington or a U.S. syndrome. I think it's a global syndrome. And it's a syndrome that we investors are not good at either. And Washington's getting worse. And that is the preoccupation on the moment. One of the big things we're focused on is the inadequacies of retirement. With low interest rates, the average person is going to have a real severe shortfall in their pool of savings, what they need for retirement. And if you overlay now longevity, which I think most people are underappreciating how long we have on this earth.
That's a rare source of optimism in this
Well,
conference.
but it's not. It's just facts. It's not optimism. It's statistics that if you're a healthy couple, 60 years old, one of the two is going to live to 92 today. And if you're 25 years old and female, you are statistically going to live to close to 100. So when you focus on these issues of retirement, and when people think about retiring at 60 or 65, you have 25, 30 years more, maybe as much as a third of your life in front of you. And so this whole notion of retirement at that age, but importantly also, it's businesses who have to change their mindset, because there are a lot of companies that have retirement targets of 62, and is that the right thing to do now? But what the problem is we are not saving for those financial needs that you're going to have, especially if you are going to retire at 60 or 65. And this is a real example of short-termism. So there's trillions of dollars money is sitting in cash. We're frozen right now. We can't, and the press loves this, by the way, because the press makes money on fear-mongering. And Blue Sky never, like the Weather Channel, Blue Sky has no patronage when it's sunny and nice, but people watch it when they're fearful of the weather. And once again, that's a human condition. And the human condition is right now, whether you're a politician or you're a CEO or an investor, you're focusing on the moment. You're fearful of what that means, and we're pulling back. Whether it's a corporate CEO sitting with, $1 trillion of cash, whether it is investors parking so much of their money in 5-year treasuries earning 60 basis points, or and
do you think there's a chance on the corporate ones that it would change after the election? Do you think there's a chance that just after that, all those people sitting on that money will think something, the fiscal cliff, something will happen?
Well, the election doesn't change anything. And this is one of the shameful things about our debates. We had 3 debates to help people make a determination who they're going to choose, and the most important issue affecting the next president will be how they deal with the fiscal cliff. And not one question from one of the interviewers, and they were these were independent questions that they all asked, and not one question was asked. How are you going to deal with that? And by the way, if they asked that question, I think the 2 candidates would have been forced to be addressing all their positions that they stated, and you could go back to how does your position interface with this fiscal cliff? And so, I believe this is a serious issue. Once again, our politicians are waiting for the moment. CEOs are not willing to make long-term investments right now. We're sitting in hoarding cash. And to reward our shareholders, we're sitting here now saying, let's go buy back shares. we could do that. So that explains why equity markets have done better than our economy, is because we're just buying back more and more shares. And obviously, earnings have been somewhat better than we thought a year and a half, 2 years ago. But the preoccupation of today and not focusing on long-term planning, whether it is infrastructure investing, whether it is addressing our deficits in a long-term fashion, or in Europe, addressing the long-term needs of Europe to stabilize Europe. And so we are going fit and starts. And for many people, they just have an inability to think anything beyond the moment, and so they're frozen. And I think one of the big problems in our financial system now, all this money sitting in the short end.
But do you think that that's a mentality which you can explain due to the risk at the moment, but do you think in terms of the financial markets at the moment, there are structural things you could do in order to alleviate short-termism? I mean, it's one, as long as I've been writing about finance, which is a mere 25 years, there has always been this issue where you meet a lot of people like you who are worried about people taking too much of a short-term approach, yet it's very difficult to come up with things which don't constrain markets.
Well, I think the first thing we need to address is I think the accounting standards are horrific. When we think about Solvency II, which is a big thing in Europe, why on earth do we care about 1 year VAR if you're an insurance company with a 25-year liability?
Yeah, that's true.
So I even question the whole notion of accounting standards today and how they look at asset valuations, but they don't ask you to look at liability valuations. And why aren't we now matching assets and liabilities? And why are we worried about 1 year VAR? So one thing one has to truly look at, is it proper to focus on this 1 year VAR? Should we be focusing on quarterly returns? Why are these measurements so much shorter when, let's assume you're a pension fund, your liability is 30 years, and so we are just so preoccupied, in the quarterly sweepstakes, who's doing what type of total return.
Do you feel that
noise
from where you're sitting? Do you feel that pressure, even with the amount of money you have? Oh, not you have, but you control.
Yes, I got it. Sure. I was with one of the largest sovereign wealth funds, the leader of the sovereign wealth fund, at dinner not too long ago, and I said, "So, help me out. How do you measure your performance, and what is your objectives?" He said, "I could clearly tell you my objectives. My objectives are generational." And I said, "So then, how do you measure yourself?" He said, "Quarterly."
No, it's true. No, it's the way people think.
I said, "Isn't that a disconnect?" And he said, "Yes, but I'm not. That's how I'm being measured."
Just going on to the short-termism politics and the fiscal cliff, do you worry at all? Well, again, it came up earlier in conversation, the idea that the US could get downgraded again.
Sure. I mean, obviously, if our behavior shows that we cannot address the fiscal cliff, if our behavior shows a total binary positions, and with little bipartisanship in trying to come to terms, there's a very strong risk of downgrade. BlackRock actually has a sovereign risk index, and at the moment, the U.S. out of 28 countries is 14th. Okay, and one of the measurements we look at is a willingness to address deficits. And if there's another, I'm not part of the team that does the evaluation, but I would imagine if we see another sign of willingness or unwillingness to address this,
But there's an interesting disconnect. When I talk to people like you, people sort of fess up and come up and talk about that quite openly. Within the broader market, there doesn't seem to be the idea that somebody like you might think that's a strong possibility or a possibility would be quite frightening, I think. People haven't really thought through what the ramifications of that might be.
As we saw in August last year when we were downgraded the first time, it actually caused people to buy more treasuries. Yes. So why was that? So I look at risk as a giant swimming pool. And our benchmark of risk is U.S. treasuries. And when U.S. Treasury represents more risk because of downgrade, and that volume increases, you have water going out of the pool, and you have to sell that excess water. You're not going to sell your benchmark. You're going to be selling all the other things around there to keep your risk constant, or you decide to build a bigger pool and have a little more risk. So the downgrade is not going to be that meaningful today if, indeed, the foreign investors of the United States who buy U.S. debt still believe the U.S. is a benchmark. So it's unfortunately a binary psychological issue. If we still are believed to be the benchmark of the world, and that benchmark gets downgraded again, if people still believe it's the benchmark, it doesn't change the need to own treasuries. But if over a long period of time there are other avenues to invest in, whether other instruments to invest in that will be a better bearer of benchmark risk, then in the long run you'll have real problems, especially if we have large deficits.
And very quickly, one last thing on the fiscal cliff. Are you one of those people who thinks that we had a debate last night where there were some people saying, look, actually it's so bad that they might just do something in the short term. There might be some kind of deal between the new president and a Congress, or do you think it's not likely to really come through?
Well, I think it depends who's the president, because I believe all the work that's been done so far was the assumption that President Obama was going to be reelected, and I think they were working on all the different types of platforms they could do. I think the issue is if Governor Romney is elected, I think there's a lot more work to be done. Governor Romney made some very large statements related to how he would fix the economy, which includes tax reductions and a few other things. And that's going to be a very difficult thing to do in front of a fiscal cliff. So there has to be some form of pivot one way or another and how we do it. My view is they're going to come with some low agreement. They're going to announce a $300 to $400 million deficit cut during the lame duck session, and with the idea that they will defer everything for 6 months.
Yeah.
And hopefully during that period of time, there is real process and a real process in which they work towards a resolution. I had 2 senators visit me this past week, and both involved. One person was part of the Gang of 8, and that's how I'm getting this information, and they were telling me all this, and I said, well, if you're going to push it off for 6 months, can you do one thing for the American population? He said, what's it? I said, can you make sure that until this is fixed, there's no congressional recess, that they stay there the whole time and get the job done? Now, obviously, he couldn't speak for the Congress, but whether it's a 3-month deferral or 6-month deferral, we need to see as citizens of America that our Congress is really attacking this and doing it well. And I think one symbolic way is that they're not taking vacations. They are there working towards truly fixing our problem.
I want to ask you about the US banking system and the euro quickly, but just one thing on Washington, which I said earlier, that a number of people have come up and said, you're talking to Larry Fink, he's one of the people who people talk about as being Obama's Treasury Secretary. Would you be interested in that?
As I said publicly before, I have a great job. I am honored to run BlackRock. It's something I've done for 25 years. Why not run
an entire country?
Well, there's a president who does that. I have a great perch. I'm really happy with my perch. And I think there's a lot more opportunity where I'm sitting already.
I will let you keep that. On the banking system, which might be curiously part of that job, the US banking system, you're a big holder of Citi. Just take me through where you see the US banking system, and actually particularly the US banking system against other countries.
We're in great shape. The US banking systems, I think the stress test that Secretary Geithner did is going to be in history looking back as the real pivotal change in the US economy. We were able to raise, from the private sector, $80 billion of equity capital within a few months after the stress test, and that stabilized the banking system. And over the last 3 years, the banks have rid themselves of a lot of toxic assets. They've raised common equity. And in fact, one other thing that people are missing, we're starting to see debt unlocked. If you look at business loans, you're looking at small business loans, other types of loans. It's unlocking. Loans are up about 20% in the balance sheets of banks for the last 18 months. So you're starting to see some real good.
It's the beginning of a virtuous circle where, because credit is gradually improving, the amount of money they set aside will not be used in the end. Or may not be.
Or may not be, and obviously that's another improvement for the economy. But the key for a lot of the banks, our housing sector has, it's taken 6-7 years to stabilize, but we're a full year away from full velocity. But we're going to start seeing improvement.
You're beginning to see something in the real estate market.
Yeah, we need, we had 7 to 8 million unsold homes in 2007. I mean, think about it. We need 1 million to 1.5 million new homes every year, and yet we had 8 million unsold homes. I mean, you put that in perspective. How did we get there? But that's history.
That's another story.
But we were there, and we need, as I said, 1 million to 1.5 million new homes. So it just takes time. So when I was asked repeatedly by people in Washington, what should we do? I said, time. Yeah. If you do some governmental programs, you accelerate it a little bit, but it's not going to fix anything that terribly fast. You just have such an overhang, and the overhang is slowly working out. Time is slowly working it out. And we're starting to see pockets in America right now where housing's starting to turn around. You're starting to see prices pick up. And my big view is if you look at the chart of rental prices and home affordability, home affordability has never been better. But psychologically, once again, people are frightened of doing anything. So they're holding back. People are renting. They're willing to pay a 30% increase in the rent the last 3 years because that's how much rental went up, just because they're frightened of the permanent loss of in their home. And it is my view, if there is that stability and upward trend, beginning of an upward trend in valuations of housing, you're going to see a flood. Because there is such a backlog of young families that that are in need of a house, but they're just struggling about when do they enter. And I actually believe you're going to have within a year, you're going to have Pulte Homes announcing a new lot of homes, and they're going to be a waiting line of people going in.
But when you look at the U.S. financial system, is there any particular bit you really worry about?
U.S. financial system? Yeah, I mean,
or particularly the banks?
I wouldn't. Yeah, if a bank's sitting with a very long duration of in assets and bonds, you got to worry. But banks have shortened up their assets so dramatically now. My biggest worry now is if I'm wrong that the economy isn't up and we have another few years of very low interest rates, that's when you're going to see greater impairment. And you're starting to begin to see that in banks' quarterly earnings. You're seeing every quarter, you're seeing 10, 20 basis points decline in ROA.
Yeah.
That's going to accelerate if we continue to be in this low rate environment, because truly most banks don't have a long duration balance sheet. So there may be a greater risk for longer term low rates. So I don't see any real problem. I'm pretty bullish on the U.S. banks. European banks have not addressed their issues like the U.S. And the U.S. and the European regulators are beginning to address those balance sheets of the banks.
What about the euro generally? I mean, you've been somewhat bullish about that, but compared with some people, if I can put it that way.
Well, I'm bearish on the euro.
Yeah. Bullish about some bits of it, or some countries within it. So
it is our view that Germany has a strong belief that they need to remain competitive. So we got into this crisis in Europe not because the government is spending a lot of money, but we got into this problem in Europe because countries continue to allow their competitiveness to erode. So if you look at a chart, and this chart is almost every politician I know reads it, governors read this. This is a chart of competitiveness by country in the Eurozone since the beginning of the Euro. And you have the southern rim countries of Europe who have seen their competitiveness versus Germany change by 40 to 50%. So it was actually more expensive to do business in Spain and Italy than Germany. And so in the last 2 years, reform is actually working. The question is, but there's a lot more to do. You're seeing in Spain and Italy, you're seeing wages and the cost of employment down about 9%. So they're still uncompetitive versus Germany. And you've seen Germany in the last 2 years seeing wages going about 3 to 4%. So you're seeing convergence. And once again, people tell me, what do you need out of Europe? You need 3 or 4 more years with lack of social unrest, which is going to be a big if. You're going to have to see this continued convergence. Now, my view also is if you happen to see a euro at 110, it would certainly help these countries in terms of competitiveness outside the euro. Yeah. And so I do believe that's going to be a necessary thing. This is why you
talked about it being 7 years at one time. I saw
it's that. Still, well, my 7 years is this convergence.
Yeah.
I do believe it's going to take 7 years, although in the past 2 years, you've seen, as I said, wages down 9%. I don't think you're going to be able to do it that rapidly. You're going to have social unrest. So I think it's going to take a little more time to see that convergence. As I said, no different than the U.S. housing market. But it is working. It is healing. And I'm not here to suggest it's going to be totally healed. I'm not here to suggest we're not going to have a blow up or things like that. But you're seeing real momentum. Now, my strongest reason why, if there is a reason why the euro blows up, I'm going to surprise you, and that's France.
Yeah.
So everyone focused on Italy and Spain. They're actually making changes. France's competitiveness is continuing to be worse versus Germany. So France, over the last 10 years, their wages are up about 30%. And this year, the spread's widening again versus Germany. You know, the 35-hour work week in France has truly made French competitive. It's pretty difficult. And we need to see France, the strongest economy, one of the strong members of Europe.
We should go to the audience very quickly, but do you see any signs? I mean, Hollande, I'm afraid I'm in the position rather publicly of taking the same position as you, but some people say we're bidding too tough on Hollande. Hollande is beginning to do stuff. He's finally got the message.
Well, he may have the message related to the deficit reductions, and that's what they're talking about. But you're not seeing the changes in the competitiveness. No. One has to understand, Spain and Italy and France, the problem is these countries spend a lot of money at the same time they become less and less competitive. Therefore, their economy slowly eroded, and so the spending outpace their revenues. So to me, the error of Europe is not the spending of the countries. The first problem was the competitiveness, and they didn't moderate their spending. And so now to get back into this, obviously, even if France moderates their spending and brings down their deficits to 4% of GDP or whatever, France still has a structural problem because it's still structurally uncompetitive versus Germany and other parts of the world. Now, if you overlay one other thing, while I'm very bullish on the U.S. versus Europe, our energy position is going to put us in a fabulous place. So I was in Germany a few weeks ago, saw the CEO of one of the large industrial companies, and he told me he's closing factories in Germany and moving to the United States. For the reason is because natural gas is $12 BTU there, it's $3.50 here. You're going to use that commodity to make downstream products. And this is one of the largest companies in the world. And he said the U.S. is going to have a manufacturing renaissance. These are his words, not mine. Yeah. But the problem is now you juxtapose what's going to happen in the U.S. in the next 3-4 years, and then you juxtapose Europe. Europe's policies, no fracking, no nuclear. Their cost of energy is going up. At the same time, our cost of energy is going down. That's going to make competitiveness even worse in Europe.
So in other words, if the American companies if you do deal with the fiscal cliff, there is a kind of, I suppose, Simpson-Bowles solution of some sort, then actually there's this tide of money and America could do very well.
If I didn't have to worry about the fiscal cliff and how we deal with our deficits, I would be wildly bullish. Yeah. I would also say I do believe we'll have some sensible resolution, and I do believe that if there is a 10 or 15% setback in the market, buy, because they'll fix it. And I really am a bull on the U.S. because of energy and housing.
Questions? If there's a person with a microphone tool who's got it, there's one there, please.
2 here.
Take 2, and then where it's.
Hi, Larry. Bill McGinley.
Hi, Bill.
Curious if you're concerned of a China slowdown.
Yes. So China's slowdown is twofold. Obviously, exports have slowed down, but when you grow at 7 to 9% over the last 10 years and your trading partners grow at 1 to 3, it's pretty hard to continue that pace. And so all the internal models at China was domestic consumption was going to accelerate, and it did not. It has not met all the internal forecasts. In fact, savings in China has gone from a 35% savings rate of consumption to, in some areas, 45%. And so to me, this is what the new leadership, they're aware of it. I've learned this from the leaders of China. So they are going to have to find ways of stimulating more consumption. Maybe it's helping out people thinking, in terms of retirement. A one-child family after 4 generations of this, each family is taking care of their 4 parents and their child. And so retirement is a bigger issue in China in some ways than the United States. And the worry of having inadequate retirement money as you're helping out not only yourself, your 2 sets of parents, is a serious issue. So, so as a result, Chinese are saving an extraordinary amount of money. And when I think that's going to be the key policy change for the new leadership of China. How are they going to stimulate consumption? And if they do that, then I'm not worried about the China growth story. In fact, I could see a period, this now the real bull story of the world. I'm not saying this real bull story is going to ever happen, but if you want to come up with a real bull,
We're always looking for a bit of optimism.
Okay, but I'm not saying it's going to happen. The real bull story would be China actually gets its consumption going. And at the same time, the United States gets its energy thing going. And there's one industrialist said one other thing related to China, which was quite interesting. He said in the next 10, because the cost of labor and the unit labor cost of manufacturing is so much lower than it was 20 years ago because of robotics and things like that, the greatest cost of manufacturing is a goods cost. So he was telling me that there could be a period of time where North America, Canada, Mexico, and the United States can be a real source of opportunity. And China will be, because if they ever get their consumption going, it's going to go from not just this manufacturing platform, it's going to be a manufacturing and a domestic consumption one. And you tie that into the United States and Canada and North America having a renaissance in manufacturing. It's a pretty, and there's poor Europe, but it's a pretty good story. Now, I'm not suggesting that all happens, but all I could say is, with all the negativity in the world, I could see moments, I could see probabilities where there could be some pretty good, interesting opportunities.
I think up there.
You mentioned that the ideal or the value of exchange rate, euro, dollar, 110 would help a lot Europe. How do you get there? And a quick question about Greece. Do you think Greece will be in the Eurozone in 2 years?
So I asked some of the governors of Europe, why aren't we there yet? And they said it's America's fault. That's always America's fault.
That's the starting point.
Yeah, starting point. Yeah, I got it. I should have known the answer. And they said it's QE3 just ruined that path. And in fact, they wanted it to get there, but QE3 ruined it. And so obviously, if we continue with our much more aggressive stimulus, QE3 is a lot more aggressive than even what the new purchasing program would do, because that's just buying 1 to 3 year debt. What the Federal Reserve is buying, obviously long dated and mortgage debt and all that other stuff. So what the United States is doing is a lot more stimulative than what Europe's doing. So I think obviously they're going to have to wait some time. Or if Europe's economy continues to deteriorate. And also, I do believe that the ECB is going to ease. I mean, the most recent data in the continent was pretty poor. I think the ECB has room to ease, which will obviously, if that happens, you're going to see a deterioration of the euro. But I would say in most of the governors I spoke to related to Europe, they recognize a weakened euro would be beneficial. But they don't think it's as beneficial as I do. They would concede that it would help trade to the non-Eurozone countries that they do trade with, but they also say some of these countries have majority of their trade within the Eurozone.
You have this race to the bottom though, don't you, where everyone's trying to get their currencies down.
Well, yeah. I mean, I don't think it's that bad, because at the same time that happens, you may see the Federal Reserve pull back. I mean, there's a lot of things. I don't see it a race to the bottom. It may feel that way. And related to Greece, I think there was a real debate in August whether Greece should remain in the euro. And I think it was concluded in September that it's better to have Greece part of the euro, because in any scenario, if Europe asked Greece to leave, they would still have to provide some type of line of credit, some type of assistance, and that assistance would be in the tens of billions of euros. And so if you're going to have to spend the tens of billions of dollars kicking them out, why don't you spend the tens of billions of euros to try to let this work itself out? And I think that is the overwhelming view of the politicians of Europe. And the new Prime Minister of Greece has done quite a bit of healing between the various other European countries.
I agree with that very much, particularly in terms of Angela Merkel. I have one more question here, and then I will wrap it up.
Thank you very much. Abal Das. Just to move for a minute away from short-termism and transaction, I'd be interested in your thought if I took what you just said about China moving along the lines of consumption and rebalancing. 4 presidents from now, how would
Does each of them have 8-year terms or 4-year terms?
Let us assume 4-year terms or 8 years, whatever it is, coming back to the question. How do you see the challenge to a United States if the general wish comes true and China becomes a consumption export balanced economy and formidably stronger than it is in terms of such president's capacity to manage the relationship between United States interest and China?
Well, let me start off right now. I believe the IMF has said that presently the yuan is an expensive currency. And the statements about China being a currency manipulator, that was maybe a year ago or 2 years ago, but the revaluation of the yuan.
You worried about a trade war very quickly. If Romney does his currency manipulator on day one?
I think it represents a severe issue, especially when they own $1 trillion of our debt. It's just, you know, it's not a good policy to have an open warfare on if you're a borrower, you know. It hasn't worked for the borrowers, the banks, you know. So, you know, it's something I would not truly recommend. Obviously, we have all the issues of intellectual privacy. I think that's a very important issue for every leader in the world. Beyond that, you know, I think if China is a big consumer of global goods, I would look at that as a positive for any leader in the world. I think the real issue, and you talk privately to a lot of people, they're very worried about how the velocity of money goes when it goes to China. It does slow down a lot versus, you know, I didn't hear what Armenia said about Brazil, but when money goes to Brazil, it's fast. I mean, they spend everything. One of the good things about Brazil, why, you know, the multiplier effect of money there is quite strong. But I don't. A strong, and I'm going to say a strong China that is a strong economic partner, and I'm talking about, you know, buying our products, you know, manufacturing products for us, is a good thing, not a bad thing for any president. And you know, I do believe if China is a full active participant in the global economy, participating in buying European goods and American goods and selling us their goods back and forth, the standard of living of the world grows for everybody. It may grow faster in China, but that's as it should. I mean, or any other country, Vietnam or Mexico, as it should. You know, when you have countries that are growing faster GDP, you're going to have that natural balancing, and I don't know if that's an issue. So, I would say a good, strong, consumption-oriented country has generally been very good for the world. And generally a strong consumption society also means it's generally a peaceful society. You know, if consumers feel good about their future and they're not worried about political or military or other risks, they generally then consume. So I would contend that if we have that strong consuming China, I would contend that the world's probably better off.
I'm going to use that as an excuse to wrap up, because actually our cover leader tomorrow, which I think is out on digitally at this precise moment, is on China and makes the point that you're better off, whatever your fears about a strong China, it's immensely better for the world than a weak China in terms of the way. I'm going to give one piece of American bashing from the European end, is that you talked about 4 generations hence. And in Tampa, Florida, where the Republicans were having their convention, I went to attend excitement a session on the future of American politics, where they had the following three speakers who were meant to show that America was marching forward into the future. They had Chelsea Clinton, George Pedro Bush, and Josh Romney. So it's nice to go back to a very dynastic society when it comes to politics.
We're following the British
Exactly.
tradition.
they should be made dukes, in my view.
Earls.
Earls, that's the least they deserve. Can you first of all, thank you all very much. I'm going to ask you to clap, Larry, in a second. But first of all, very quickly to thank you all very much for coming. Please, if you could, as I said, we are masochists. We like as much criticism as possible. Fill out feedback forms. Tell us what we're doing wrong. Follow us on the videos and things which are on the websites. I would like to thank our founding sponsor, RBC Capital Markets, the gold sponsor, PwC, and the silver sponsor, Pillsbury. Very quickly, and this shows how incompetent editors are, I had a long list of people to thank from The Economist, which I managed to leave in the green room behind, and so I apologize for the ones I don't mention, but I'd like to thank Tamsin and Natasha. I'd like to thank Sophie Sutherland, who's been both the voice of God introducing us and then the person who would normally have got me the notes, but I left them behind. I'd like to thank Sean McManus. I'd also like to pay tribute to Robin Riddle and Justin Hendricks and all the many journalists who've been here, including Philip Coggan, Zanny Minton-Beddoes, Tom Easton, Matthew Bishop, Greg Ip, and the other ones who I forgot will come and attack me on Monday. Thank you all very, very much for being here. As I said, the whole point of Buttonwood is it's meant to be a severe contest, and it is your contest as much as ours, and you've lived up to that billing. So thank you very much, but let's finish by thanking Larry, who I've given my time to. Thank you very much. Thank you.